So last time we were able to continue finishing up chapter 10 and wrapping that up. And this time we're going to focus on talking about saving and investment, which we sort of dived into at the end of chapter 10. So the first thing that we'll be talking about is how investing contributes to the free enterprise system. The second is, how does the financial system bring together savers and borrowers? Now, certain types of financial systems we did discuss in chapter 10, such as banks, so those actually serve as an example of that. And then also, how do financial intermediaries, which are basically the same as what a banking system is, how does that link savers and borrowers? Actually, certain intermediaries aren't necessarily banks, but banks are an example of one. And also, what are the trade-offs or the opportunity costs for risk and return? So, investment is defined as the act of redirecting resources from being consumed in the present day so that they can create benefits for the future. So, for example, if you put money into a savings account, that's an example. It's the use of assets to earn income or profit. So when people save or invest their money, that money actually becomes readily available for businesses to use to expand and grow. So for example, like when I was talking about last time, when you put money into a savings account, that money, or at least a part of that money, not all of it, is going into circulation for investors. So financial assets, when savers are investing, they're going to receive some sort of documentation that confirms their deposit or bond purchase, such as a passbook or bond certificate. That just signifies that, they, have done this. So these are known as financial assets. They represent claims on property or income of the borrower. And a financial system is a system that allows the transfer of money between savers and borrowers. So a bank is an example of a financial intermediary that participates in this financial system. You as a saver or borrower are technically also involved in a financial system. So financial intermediaries are any kind of institution that can direct funds from savers to borrowers. Examples of this, aside from just regular banks, are savings and loan associations, credit unions, finance companies, or mutual funds. There's other ones as well, but we'll get into that in a bit. So let's start with the first one. So as you read in chapter 10, banks or savings and loans associations, as well as credit unions, will take in any deposits from savers, and then they lend out some of these funds to businesses and individuals. So finance companies, they make loans to consumers and small businesses, and because finance companies sometimes lend money to people who don't repay their loans, they actually take on a higher degree of risk than the previous examples. So they charge borrowers higher fees and interest rates to cover their losses from the loans that are not repaid. Mutual funds, so these pull the savings of a lot of individuals and invest this money in a variety of stocks, bonds, and other financial assets, and they allow people to invest in a broader range of companies that are in the stock market. And that way, you don't risk your savings by purchasing the stock of only one or two companies that might not do well. Life insurance companies, so the main function is to provide financial protection for family units or other beneficiaries that are under the insured. Any working members of a family unit, for example, can actually buy life insurance so that if they pass away, money can be paid to anyone alive to make up for lost income. And the way that insurance companies collect payments is there's these things called premiums from the people who buy insurance. They collect those. And then they lend out part of the premiums that they collect to investors, similar to how banks will lend money from people's savings accounts to investors. Pension funds are the last one. So a pension is income that a retiree receives after working a certain amount of years or reaching a certain age. In some cases, injuries can also technically qualify as a working, may qualify a working person for pension benefits. So yeah. And this just gives you a graphic example of what a financial intermediary does. So as you can see here, these are regular customers of any kind of financial institution, such as a commercial bank. And then that money gets, part of that money, that is, again, they don't want to take all of someone's savings accounts out, especially if that person might want to withdraw. But they lend that into circulation to investors to expand. Okay. So some of the reasons in the first place, like for why these financial intermediaries even exist in the first place, is they share risk. Diversification is a term that refers to the spreading of investments to reduce risk. They help individual savers diversify these investments. They also serve as systems of providing information, right? Like if you want to learn more about what are your options of loans, what are your options of certificates of deposits. Your local bank, for example, collects information about borrowers by monitoring their income and spending. So do finance companies when anytime a borrower fills out a credit application. And then you've got mutual funds. They also provide information. So mutual fund managers, they know how the stocks in their portfolios are performing. So yeah. Also providing liquidity, which if you remember from one of the previous chapters, liquidity is how easily, readily available something can be converted into hard cash. So if you are taking out money from your checking account, it has a lot of liquidity versus taking money out of your savings account. So yeah. Okay, risk and return. So certificates of deposit that are up to $100,000, technically higher than that, I think, today because of changes with inflation, but they are considered safe investments because they're insured by the federal government. So when you buy a CD, a certificate of deposit, you're technically giving up liquidity for a certain period of time, as in it's not easy. You can't use that money in the present day because you are waiting for it to accrue interest. So yeah, and it just defines return here. It's the money an investor receives above and beyond the sum of money initially invested. So for example, if you took out a CD for, I don't know, $500 with a interest rate growth of 5%, then whatever money you accrue from that 5% over the course of, let's say the CD has a maturity rate of 5 years. So in other words, you can't touch that money in your CD for 5 years, then every single year you get a 5% additional, you basically accrue 5% of whatever money is in that account, so that you accrue more return by the time you are able to receive your CD at the end of the 5 years. And that'll make more sense. We'll review that even more so in the next section and stuff, because that'll talk more about CDs, and then later we'll also talk about stocks and bonds. So yeah, that's pretty much it for the first section. Hopefully you found that helpful.